In today's video, we are going to look at a case study, and this is based on an actual situation. So this is someone who is just approved for a life insurance policy. We're looking at a $10 million death benefit, but they've got a goal of maximizing the cash value and then using the policy. They want to be able to access the cash value for real estate and for their business as the years pass. So what we're going to look at are some different items with respect to, one, the actual life insurance policy. How is it set up? What are they committed to? How flexible is it so the policy never feels like a burden? Because you're going to see the policy size is rather large. They're looking at funding the policy at a dollar amount of $250,000 per year. And they want to pay into it for 10 years at least, which is $2.5 million. So whenever we have a situation like that, we do want to equip the policy with a lot of flexibility in the event life happens and I cannot get the dollar amount into the policy that I originally planned. I don't want to be stuck in a situation where I have to pay it, where the policy has to take a loan against itself. No, I want to make the policy very flexible. This way, I, as a consumer, am not stressed out thinking, I got to find a way to come up with the money. No, because then I'm focused on the stress of this policy and not focused on my business and other things I enjoy. And then it becomes a burden and I don't want it. You may know what I mean when I say that feeling. So let's first take a look at some of the details here. We've got a 40-year-old female. We've got a life insurance policy with a total death benefit of $10 million. That's the amount we were approved for and what we are proceeding with in this particular case. The goals are as follows: maximize cash value and then use the cash value. The funding we're looking at is $250,000 per year for at least 10 years. She may want to fund the policy longer. She does have the ability to do that, but what we'll focus on is a 10-year funding period, just because that's primarily what we've looked at thus far. And we see a lot of people interested in funding policies for shorter periods of time, at least with heavy dollar amounts. One reason why is because that does maximize the internal rate of return, but a big reason why is it allows someone to get a lot of money into a policy. And now I've got this big bucket of cash that continues to compound along with a nice death benefit. But as that cash value compounds, I can access it like a personal line of credit, knowing that I don't have to continue to feed it. And a lot of people are attracted to that. Back to this. So the funding, the goal is $250,000 per year. We mentioned earlier that we do not want this policy to feel like what? A burden. I don't want to be billed for $250,000 every year on a particular month. So how the policy is set up is as follows. We've got a minimum commitment of $27,000 per year. And that $27,000 per year could be paid annually. It could also be paid monthly. So we could divide that figure by 12. But my point here is she's committed to this with the ability to add up to $250,000 per year. Now there's one important item to be aware of here too, with respect to the funding, is that the policy has a MEC limit of $450,000. Her plan is to fund it at $250,000 per year. But she may want to add more than that in the first year, and a first year lump sum payment is available. Specifically, if she wants to add $450,000 into the policy in the first year and then proceed with her plan of $250K per year thereafter, she can do that. You'll see the exact company and the illustration and how this works. It's with Guardian, so you can see exactly how it works. If you've seen our other content, you know that the maximum PUA payment we can illustrate each year is what? If we've got a 1-year term rider attached, it's 10x the base premium that can be paid into PUAs. But in the first year, do you remember that rule that they allowed beginning 2022? I can go up to 50x the base premium in PUAs. So I can get a heavier lump sum into the policy right out of the gates, which will accelerate the cash value performance, and the break even looks pretty good. So we will look at a scenario like that because there was interest there, and we've seen a lot of people interested in these types of funding scenarios or funding options. So what we will look at is as follows. We've got option A, minimum only. This is beneficial to see because she's going to fund the policy with more than just the minimum. However, if this is you and you said, I want to do this, $250K per year, but I do not want to be committed to it. Set it up, Steve, so I'm only committed to the minimum. When you receive your formal policy from the company, so let's call it your formal contract, which often has a copy of the illustration enclosed in it, whatever amount we set up for you to be billed every year will be the dollar amount you see in that formal contract. Meaning if you plan on adding unscheduled PUAs, but you don't want to be billed for it, so you can add the additional funds, but you might not add the additional funds, that won't be reflected in the cash value buildup. So as an example, if the minimum we have is $27,000 per year, the formal contract is going to read what? $27,000 per year. We'll look at an illustration that reflects exactly that in a couple minutes. So that's option A. Then option B, the exact same policy, but what it looks like if she funds it as planned at $250K per year for 10 years. Then option C, which is again the exact same policy, but starting off with a heavy lump sum, $450K, and then $250K, years 2 through 10. And then we've got option D, which is $450 in the first year only, and then the minimum. What do the different scenarios look like? And one thing to keep in mind, we've got the different scenarios here, but it is all the same policy. If this is you, you do not need to declare upfront which option you are selecting. If the policy is set up to be very flexible, you can do this and then add more funds to your PUA rider as time passes. So let's take a look at the illustration and we'll begin with option A. So we've got a full illustration here. Let's take a look at the ledger statement. And what do we see? So health rating, standard non-smoker here. Here's our net premium, which is the same as our net after-tax outlay, $27,000 per year. Now, if this is me, knowing what I know in the business, here's the question I would have before signing off on this policy. Where's my money going? Of this 27 grand per year, where is it going? How do I know that the policy is set up correctly, aside from taking my agent's word for it? So here's how you know. So we've got the 27K per year going in. The policy, that $10 million death benefit, gives her a MEC limit of about $450,000. It's actually about $458, so closer to $460, but we just rounded down in this scenario to a clean $450. The MEC limit is $458, but when I say rounded down, when you see the lump sum of $450, I just made it a clean $450. But that's how high I can go. So that's an IRS limit, the MEC limit. My premium, where on earth did we come up with that number? $22,727 and change. Where we came up with this number is, aside from the first year, so this is Guardian, when I look at my PUA rider, beginning the second year, if I have this rider attached, this 1-year term is critical. If that's attached, the maximum that we can illustrate, meaning the highest dollar amount I can show in these illustrations, will be whatever that base premium is times 10. 10x that in PUAs. So another $220,000 and change. Add those two figures together, or multiply this by 11. And guess what you'll get? $250,000. To simplify things, we're simply understanding the limits that the insurance company offers and playing the game within those limits. How low can I go on the insurance expense? Because that premium, how much of it shows up in cash value in the first year? Next to nothing. Look at your cash value in the first year with the minimum only. That takes the biggest bite out of cash value, particularly in the first year. So often what we aim to do is minimize that expense. That also minimizes your commitment to your build for the minimum amount and can add more funds at discretion. But multiplying that by 11, that's where we come up with the $250,000. So we're minimizing expenses and maximizing cash value. So we've got the premium. Here we have a term rider attached. Here's the cost of that term insurance rider, just about $4,000. So when you add these two figures together, we're close to $27K. We're a little bit under. So what I did was just round up to $27,000. So your $27,000, if this is you, what happens is first, it covers the base premium, then it covers the term insurance rider, and everything else goes into a scheduled PUA. So I do see a little bit of cash buildup as a result, which is good. That's the name of the game. We want the cash buildup. So if she goes with this option, which is her plan, what'll happen here, she will see this as the billed amount every single year, $27,000. And when she first starts her policy and signs off, guess what she's billed for? $27,000 that she will send in at signing. I use my pen, but typically e-signatures and e-payments are the way to go in today's age of technology. But this is what the actual policy looks like. And when I look at the cash value buildup, it looks horrible. It takes close to 20 years before I actually see my break-even point occur. Right, so here's my total payments, $540,000 in, cash value, $559 the year prior. I'm negative, meaning I have less in cash value than what I paid in. That's because I'm paying primarily just the base premium. I've got a small dollar amount going toward PUAs. I'll often refer to this as a great example of what not to do, meaning having a policy where I'm only paying the base premium if my goal is high cash value. That's the main point there. So let's look at this exact same policy. And here's what I would look at here. Here you've got a scheduled PUA rider. Keep your eyes on this section. Same illustration. What do you notice here in that same section? What has not changed? Base premium, scheduled PUA. What do we see there that's different? See that extra line, paid up additions rider, unscheduled? There you go, $223,000. So an unscheduled PUA payment means you're adding it on an unscheduled basis. You don't plan to do it. Maybe you do plan to do it, but you're not committing to it when you start the policy. If you're committing to a PUA payment, it will be set up as a scheduled PUA payment. What's important to note about this is while we see this on the illustration, you're not required to make this payment or you're not billed for it. You actually have to send the funds in, typically through an online portal or mobile app. You could do it via check as well, but that's how unscheduled payments are made. You can set it up on day one. For example, if she said, I want to start off with $250,000 the day I sign the contract, but then each year I want to be billed for $27,000, you can set it up where the initial unscheduled PUA payment is billed. So you've got a total amount of $250K, but then every year thereafter, we would see $27,000 billed, even if you have the other $223 in unscheduled PUAs on the illustration each year. So I just want to make sure that that part is clear. Unscheduled PUA payments will not be billed every single year. What this is beneficial for, though, is when you look at the funding now, year 4, total of what has been paid in? $1 million. There's your break-even point. Quite attractive, isn't it? And let's look at the first year cash value. So you paid in $250K. Your cash value is $219,000. So what's your hit in the first year? What you can do here is take the 219, take the exact amount, 219,019, and divide it by 250, your payment. And there you go, 87.6. So what that is the percentage of your payment that shows up in cash value in the first year. So the hit is what? A little bit more than 10%, but first year I've got 87 if I round up to 88%. We'll show you how to get that a little bit higher. But the main difference, or the only difference here, is the fact that I've added additional funds into my unscheduled PUA rider. Let's progress on. Same thing, but with that larger lump sum only in the first year. Same thing. Look at this, base premium, scheduled PUA, covering the term rider and such, still committing just to the minimum. That's what those two do, those two figures. Then a large lump sum right out of the gates, 450K. Okay, so there's the 450. What's your first year cash value? 414. Question, is that 87% or 88%? It's not. Want to see what it is? Here's what you can do here. Do the same thing. So take your cash value, 414, 477, and divide it by 450. Now what do you have? 92% right out of the gates. So that is one nice feature to Guardian policies, especially if I'm starting with a large lump sum, if I'm in a position to do that. And it makes sense when we analyze the different ways to design the policy, discuss how long you want to fund the policy. We've got other videos that go through that, or how we decide upon that. But my point is, in this situation, it looks pretty good. I like that quite a bit. And when you look at the break-even point, what do you notice there? How close are you to year 3? By year 3, so year 1, 450, year 2, 250, year 3, 250. Here's my total payments here. $950,000 in total funding. Here's your cash value, $944. Keep in mind, this is with a standard non-smoker rating. So almost there year 3, and then year 4, you are positive in this particular case. And we always like to look at the guarantees as well. In this video, we're just focusing on the non-guaranteed values, the dividend values, but it is with one of the major mutual companies, Guardian, that we've seen perform. Meaning, when I look at actual performance compared to illustrations, I've seen them perform very, very close. And when the dividend rate hasn't changed and payments have been consistent, meaning someone funded exactly as illustrated all up front on their anniversary date, I've seen the performance be identical to the illustration in many cases, which I love. Obviously, but there's the performance there over here at the cash value. So what we also like to do in a case like this is simplify things a bit, because those illustrations are 18 pages a pop. And there's a fourth one we didn't look at. I'll show you real quick without going through the same details. It's the same thing, but it shows 450 and then just the minimum thereafter, 27K, stopping at year 10. Although if we go back to the first one, we showed the funding continuing on. So if you're looking at this, if this is you, do you feel overwhelmed at all? Maybe, maybe not. Depends on how much you've dug into it and such. The first time I looked at all of this stuff, I did feel overwhelmed. One illustration can be a lot, especially if it's 18 pages. I've got all the definitions and terms. Now multiply that by 4. It's like, okay, I'm glad I have them all, but it's still a lot. How do I simplify things? So what we've got is as follows. We've got options A, B, and C, A, B, C, and D, which is exactly what we looked at, but all on Excel. So we've got the minimum only, which is what she will be billed for each year. So if she starts with $27,000 the day she starts the policy, and then the next week or the next month or any time elects to add more money into PUAs, she can do that. That's a huge benefit to Guardian, in my opinion, with their flexible PUA rider, where literally I just throw more money into PUAs, and that can be another $223,000 to get me up to a total of $250, or maybe it's $5K here, $50K here, then I throw in $200K, can literally do it however I want. So very, very flexible. What is highlighted in yellow represents the break-even point. So one thing that I did not highlight on the illustration was option D, which demonstrates the large lump sum in the first year only of $450,000, and then just $27,000 per year thereafter, stopping at the 10th year. Look at that. So starting off with a lump sum can really put one in a good position in terms of recapturing the payments they've made into a policy very, very quickly. I know that that brings a lot of people peace of mind. And I've seen that with individuals putting in 10 grand per year and then 6 and even 7 figures per year. When's my break-even point? When do I recapture the payments made? When do I start to see the benefits? That's often a big point of concern. So I like to highlight it and we get it to break even as early as possible, without sacrificing long-term performance. We always want to hit on that. So we've got the growth scenarios. What was step 2? Because these display what? One policy, maximizing the cash value, but also demonstrating the flexibility. So she sees what the policy will look like if she funds it with different dollar amounts. And also has the awareness that when I receive my formal policy, and I've got the minimum only going in, when those cash values do not look that attractive, well, that's because the policy is only reflecting the minimum going in. Now I've got awareness on that. It'll look good if I move forward with adding the additional funds. So let's take a look at using the policy now, because that's a goal, or desire, I should say. So what we'll look at is the heavy fund scenario. And we can look at any of these. When working with someone, what we'll do is send the illustrations and also a workbook like this, which actually allows you to take any of these scenarios we looked at initially. So if we go back to tab 1, where we have those 4 scenarios, we can take any of those and just drop them right into this workbook. And then everything to the right will update. But what we've got here is the scenario, $450 in the first year, about 92% of your payment is available in cash value, which 92% sounds great for a whole life insurance policy, because it is. But then also, to be fair, like what I want to look at here is the fact that my internal rate of return, there's the negative hit, 7.89%, which on $450,000 comes out to what? $35,523. Whatever the negative hit is, I want to make sure I hit on that every single time and look at it on an annual basis, so someone has full transparency. It's also being spoken about that, hey, here's the drawback to it. This is often what turns people off, if anything does. So I want to make sure that that's very, very clear, because I would like that before starting a policy. You know, when you get excited about something, you think you see everything, and then a year later you look at it again and say, how did I miss that? Or how did I overlook that? Well, if someone says it out loud, that can prevent that. All right, so here we go. There's my break even, almost year 3. And what we've got is the annualized internal rate of return, but then also in dollars. What's the net cash value growth every year? And on the far right, the total gain on cash value. In year 3, I'm in the red because I've paid in $950,000 and I've got $944 in cash value. That's why I'm almost negative $6,000. The next year, I'm no longer in the red. I'm positive. And that just shows the total gain. So for example, I paid in $2.7 million. By year 10, I've got a gain of $470,000, which means I have my 2.7 plus another 470. There I go. And a healthy death benefit. From an estate tax planning standpoint, that can certainly be suitable. It depends on your situation, of course, but that's where death benefits really come into play, in addition to income protection. So let's take a look here at some loan scenarios. LTV, loan to value, 95% of cash value. So typically with a whole life insurance policy, whatever you see in cash value, on average with most companies, you're going to be able to take a maximum loan of about 95%. That's what this column represents. What we'll look at next is this. So here's what we've got. Annual loan, we can plug numbers in here. Then loan repayment, we also plug numbers in here. We don't have to do anything with this. The loan interest rate we can adjust if we want. You'll see cash value collateral loan. So this is actually meant to demonstrate a cash value collateral loan, not a direct policy loan. Although that is something we do like to model as well, especially if one's considering taking direct policy loans. But even if you're not, it's good to see it. So you can see the exact impact that a policy loan will have on your cash value, death benefit, what does it look like if you pay interest, don't pay interest, all of that important stuff. But here's what we've got. So let's do this. There's one more thing we're going to have to the far right before we start looking at numbers. Policy growth versus policy interest. So annual loans. Let's take a look at this. So let's assume that she starts with a lump sum payment and she takes out a loan in the first policy year, which from a pure number standpoint, I typically do not recommend. And here's why. So let's take a $300,000 loan, because she'll have access to that, no problem. If I take a $300,000 loan, what happens here? Assume that the cost to borrow is 5, which if she goes with a direct policy loan, Guardian does have a fixed loan interest rate of 5%. So we can look at that for the sake of this example. That's a cost of $15,000. We've got annual interest payments, what she would be paying each year, and then total interest payments, tallying up the entire year. But first year, if we look to the far right, here's what she's gaining. Well, the first year she did not gain anything. It was a loss of $35,000 and change. She also paid $15,000 on top of it. So when asked what are the drawbacks to a whole life insurance policy, particularly when one is interested in high cash value, the number one answer to the question is the first year is the worst year. Without loans, I have less in cash value than what I've paid into the product. In addition to that, if I'm going to borrow against the policy, there's a cost there. In addition to taking a hit in the early years, I'm also paying loan interest. That inflicts financial pain. That's the number one drawback that I always like to mention up front with respect to whole life insurance policies where cash value is the goal. Now, often people are aware of that, and they still elect to take loans in the first year because they know over time they can make up for it, which I completely get. It's just a case of having transparency to know exactly when do I make up for it, because that's important. Let's assume she takes that $300,000 loan and then beginning the second year repays it at $100K per year, which is in addition to the interest payments. We're assuming the interest is being paid out of pocket. But if I apply $100K per year toward the loan principal, in 3 years it's paid off. The total interest I've paid is $30,000. So let's look over here. Growth versus interest. And that should be interest paid. That's the loan interest I'm paying to the insurance company in this case. By year 4, total interest payments, total gain on cash value. Oopsie daisy, I said year 4. Total interest payments, total gain on cash value. A little bit behind, right? If I want to look at year 3, however, what was your gain? $18,000, isolating that year. What did you pay in interest? $5,000. Okay, so on a yearly basis, I was ahead. I like to show both because individuals prefer to look at one versus the other or both, but if I've got both, I can look at the one I prefer and delete the other, or just keep them both there. So I know exactly what the growth is compared to the loan interest paid. So let's assume we take a big loan here. Let's go $1.2 million because I can borrow up to $1.4 million. There we go. Okay, 1.2, $60,000 in loan interest paid. That's at 5% of the 1.2. What did I earn this year? Let's just look at the far right. $41,000 in growth versus $60,000 paid. Let's begin to repay it. And you know what? Why don't we get creative here actually and assume that she says, you know what? I don't want to pay anything toward the principal until after the 10th year, because at that point in time, I'll no longer be funding the policy. So let's pretend that I just pay the $250 plus the loan interest, and beginning year 11, I'll begin to attack the loan at $200K per year. I'll take the majority of what I was paying the $250 and redirect that toward loan payments. And in 6 years, it's paid off. Now I can look at everything side by side. It's really just plugging the numbers in and seeing what an individual's comfort level is, what works and what doesn't work. But here we go, yearly cash value growth. You can look at it down here as far as when I'm in the red and when I'm in the black. And then same thing with the total gains versus the total loan interest. So when working with individuals, really what I like to do here, what our company likes to do, is show this exactly, the growth in the loan scenarios, and continue to work with an individual throughout the life of the policy. Because if I work with a real estate investor, for example, or someone who is a hyper performer in terms of business, this woman does extremely well in business. I'm like, how do you guys move so fast? But she's very, very good at what she does. Going back to the real estate investor, They're very, very good at what they do. We specialize in whole life insurance and going through the mechanics of that. So what we do in terms of service as time passes is help provide transparency around the numbers. So when you're using the policy to complement what you are very good at, we want to make sure that we provide transparency and say, okay, if you take a $1.2 million loan here and your cash value is performing at 2.79, just about 3% on the IRR, here's your growth. And for full transparency, the year you do this, or for the next 2 years, the interest cost is going to exceed what the policy is producing in growth if we just isolate it on a yearly basis. However, you will make up for it quite quickly, but that is something that if you and I flip positions, I want to be made aware of that. And then you might look at that and say, you know what? Let's kick that loan actually down to $1 million or perhaps $900,000. And we send this workbook if you're working with us, if you have a policy with us or working with us in any capacity. But this way you can look at it just side by side. And yes, there's times we have to adjust the interest rates and such, and then also see the impact on the death benefit. But my point is, if we can provide transparency with the numbers, we prevent an, oh, I didn't know that situation, which is a big no-no, especially when you are working with people's money. So I hope you enjoyed this video. I had a ton of fun with this case study. If you did enjoy it, please hit the like button, subscribe for more, leave any questions below in the comment section. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.